There is a number sitting in your bank's computer system right now that decides whether your own money gets watched, reported, or frozen, and you were never told what that number is. The moment certain activity crosses a hidden line, your bank is legally required to alert the federal government, and it is legally forbidden from ever telling you it happened. There is a second kind of report that has no dollar minimum at all and can be triggered by a transaction as small as a few $100s. And there is a rule that took effect at the start of 2026 that allows a bank to lock a senior out of their own account for up to 15 business days with no warning and no explanation. None of this is on your monthly statement. None of it is explained when you open the account. And the part that traps good, honest people the hardest is not the rules themselves. It is the instinct people follow the moment they learn the rules exist, because that instinct is exactly what turns a completely legal bank balance into a federal case. I'm Mason Parker, and for over a decade I've tracked the retirement rules, senior benefit programs, and banking regulations that quietly affect people every single year. Today I'm walking you through 7 specific moves happening inside your own bank account that nobody sits you down to explain. If you're not subscribed yet, this channel is built for people who want the warning before the freeze, before the flag, before the deadline, not after. Hit subscribe and turn on the bell so you don't find out about the next one too late. Before we get into the 7, there's a scam running right now in 2026 that specifically targets seniors who just learned about these exact rules, and I'll show you how to spot it in seconds. And stick around for a bonus near the end. A government-run website where your idle savings can earn 4 to 5%, backed directly by the U.S. government with no bank limit and no FDIC cap, and it takes about 15 minutes to set up. Let's start with the rule that catches the most people off guard. Since 1970, under the Bank Secrecy Act, any bank or credit union has been required to file a report the moment you deposit or withdraw more than $10,000 in cash in a single day. That report doesn't go to the IRS. It goes to a federal bureau most people have never heard of called the Financial Crimes Enforcement Network, or FinCEN, tucked inside the Treasury Department. Your bank files it. You never sign it, never see it, and in most cases never know it happened. For the overwhelming majority of people, this report goes absolutely nowhere. Sell a car for $12,000 cash and deposit the whole thing the same day, and a report gets filed and nothing happens to you. It's routine paperwork. But here's where good, honest people walk straight into trouble. The instant most people learn about this $10,000 line, their first thought is to just stay under it, depositing $9,000 today and a few thousand more next week. That decision has a name: structuring. And under federal law, structuring is a felony, not a warning, not a fine you can shrug off. A felony. It doesn't matter if every dollar is completely clean, inherited, gifted, or saved over a lifetime. Breaking it into smaller pieces specifically to dodge the report is the crime itself, regardless of where the money came from. And here's something almost nobody explains. The law used to require prosecutors to prove you knew breaking up deposits was illegal. Congress erased that requirement back in 1994. Today, the government only has to show you meant to stay under the line, not that you understood it was against the law. Not knowing the rule is no longer a defense. Get caught structuring under $100,000 in a year, and you're facing up to 5 years in prison and $250,000 in fines. Cross $100,000 and the number doubles to 10 years and $500,000, and the government can seize the entire account through civil forfeiture without ever charging you with a crime. Ordinary retirees and widows have lost life savings this way because a deposit pattern simply looked suspicious, even when every dollar was legitimate. And spreading deposits across different banks to dodge the limit doesn't get you around it either. It's the same felony because the federal system aggregates the pattern across every institution you use, even if no single bank sees the whole picture. The move that protects you is simple. Deposit the full amount at once, keep a paper trail showing exactly where it came from, and never split a transaction just to stay under a number. Beyond that $10,000 report, there's a second kind of filing with no minimum amount attached at all, called a suspicious activity report. A bank can file one on a transaction of $500 or less if it simply doesn't match your usual pattern. And by law, no employee is allowed to tell you it happened. You could be flagged today and have no legal way of ever finding out. It's not the size of the transaction that trips the alarm, it's the change in behavior. Withdraw the same $300 a week for 15 years, then suddenly ask for $8,000 for a roof repair, and the automated system flags the deviation because that's exactly what it's built to catch. The fix is to walk in prepared. Bring a contractor's estimate, a receipt, or a short letter explaining the purpose before you make an unusual withdrawal. A flag with an explanation already attached tends to resolve quietly. A flag with nothing behind it is the one that escalates. Then there's the newest and most invasive rule on this list, the one about the account itself. As of January 2026, banks and brokerages nationwide gained expanded authority tied to new elder protection standards to place a temporary hold on any account belonging to someone 65 or older the second their system suspects possible financial exploitation. That hold can last 15 business days, and because weekends and federal holidays don't count, a freeze that starts the Thursday before a long weekend can stretch into nearly 4 full calendar weeks, with zero access to your own money while direct deposits keep arriving and bills keep coming due. The intention is legitimate, since seniors lose billions to financial predators every year. But the side effect is that a completely clear-headed retiree withdrawing $20,000 to help a child with a down payment can get pulled aside, questioned, and frozen out if the automated system isn't satisfied with the answers. Once that freeze hits, a teller can't lift it, customer service can't lift it, and often even the branch manager can't touch it because it sits with a separate compliance unit you're not allowed to contact directly. You just wait. The way around this is to get ahead of it. Call your branch a few days before any large withdrawal and ask them to log the reason on file in advance, and set up what's called a trusted contact, one person whose name and number the bank keeps on hand, so that when a large transaction gets flagged, the bank calls that person to confirm you're fine instead of freezing the account outright. It costs nothing and it can stop the freeze before it ever begins. Here's a gap almost nobody explains clearly. FDIC insurance only protects up to $250,000 per depositor, per bank, per ownership category, not per account. If you're sitting on $300,000 in a single account at a single bank and that bank fails, $50,000 of it simply isn't covered. This isn't hypothetical history. In 2023, 3 of the 4 largest bank failures in U.S. history happened within about 8 weeks of each other. Anyone under the $250,000 line was fully protected. Anyone over it was only made whole because of a political decision, not a legal requirement, and nothing guarantees that decision gets repeated next time. What most people don't realize is that the $250,000 limit resets for every separate ownership category you hold at the same bank. A single checking account, a separate IRA, and a payable on death account each get their own $250,000 bucket at the very same institution. One person alone could have $750,000 or more fully insured without moving a single dollar elsewhere, and a married couple using individual accounts, a joint account, and separate IRAs at one bank could have well over $1 million fully covered. The free tool that tells you exactly where you stand is called the EDIE calculator, available at fdic.gov. Plug in your accounts and balances, and in about 5 minutes it tells you exactly how much is protected and how much, if any, is sitting exposed. Now, the scam warning I promised, because the people running it prey specifically on seniors who just learned about freezes and coverage gaps like the ones above. Here's how it works in 2026. Shortly after watching a video or reading an article on this exact topic, a senior gets a call or email from a company calling itself a bank account safety audit service, a federal compliance review firm, or a senior financial protection specialist offering to check your accounts for reporting flags and coverage gaps for a fee anywhere from $200 to $500. Every single thing they're offering to check is something you can check yourself for free in minutes. The FDIC's own calculator is free. The reporting reporting rules are public information. Setting up a trusted contact is a free phone call to your branch. There is no paid service, no special database, nothing these companies can do that you can't do yourself for $0 right now. If anyone contacts you offering a paid audit or a compliance review for a fee, hang up and report it to the FTC. Now, the one I want you to send to someone before you finish this video, because it's the single most damaging and best-intentioned mistake I see in retirement planning. At some point, a friend, a neighbor, or even a bank employee suggests adding an adult child to the account just to help with the bills, and it feels like simple, responsible planning. It's actually one of the riskiest moves you can make with your savings for 4 reasons most families never see coming. First, the moment your child's name is added, the money is legally theirs too, today, not someday, and their financial problems instantly become your financial problems. Their divorce, their lawsuit, their unpaid taxes, their bankruptcy, all of it can reach into that account even if they never deposited a cent. Second, a joint account with survivorship rights bypasses your will entirely and goes straight to whoever's name is on it the moment you're gone, no matter what your will says about splitting things evenly among your children. Third, if you ever apply for Medicaid long-term care, the state reviews 5 full years of statements, and the entire balance of a joint account counts as your asset regardless of whose money it actually was, which can quietly disqualify you right when you need help the most. Fourth, any joint owner can legally empty the whole account at any time without asking anyone, and it happens more often than people think, leaving other heirs with nothing despite your intentions. The fix costs nothing and takes one conversation at your branch, a payable on death designation. You stay the sole owner for life. Your child has 0 access and 0 ownership while you're alive. So no creditor, no divorce, no IRS lien, and no bankruptcy trustee can touch it, and Medicaid only counts what's actually yours. The moment you pass, it goes directly and immediately to whoever you named, in the exact shares you chose, without probate, without a lawyer, and without months of delay. Brokerage accounts have the same fix under the name transfer on death. And here's the part that connects straight back to the FDIC gap. Naming a payable on death beneficiary moves that account into the revocable trust insurance category, where each named beneficiary adds another $250,000 of coverage. Name 4 beneficiaries and one account at one bank can carry a full $1 million of protection. Finally, the bonus. Most retirees only need 3 to 6 months of expenses sitting in checking or savings, usually somewhere between $15,000 and $25,000. Everything above that is just sitting in an account being watched by automated systems, earning next to nothing, and losing value to inflation every month. There's a place for that extra money that most seniors have never considered, treasurydirect.gov, run directly by the U.S. Treasury. Through it, you can buy Treasury bills straight from the federal government, no bank in between, currently yielding around 4 to 5% in 2026. They're not FDIC insured because they don't need to be. They're backed by the full faith and credit of the United States itself, with no $250,000 ceiling and no bank failure risk. Setup takes about 15 minutes, minimums start as low as $100, and terms can be as short as 4 weeks, so your money is never locked away for years. So here's all 7, boiled down to one move each. Deposit or withdraw large cash amounts all at once, never broken up, and keep the paperwork proving where it came from. Never structure transactions to dodge the $10,000 line at one bank or across several, because ignorance of that rule stopped being a defense back in 1994. Before any unusual withdrawal, walk in with documentation already explaining it. Call your bank this week to set up a trusted contact and to pre-notify them before any large withdrawal. Go to fdic.gov and run the free EDIE calculator to see exactly where your coverage stands. If your adult child is currently a joint owner on any account, call your branch this week about switching to a payable on death designation instead. And for any savings beyond your 3 to 6 month cushion, look at treasurydirect.gov this week for Treasury bills. None of this comes looking for you. Your bank won't call to tell you you're over the FDIC limit, and the government won't mail you an explanation of what triggers a freeze. The system stays exactly as it is until you decide to move first. If this helped, share it with someone over 65 who keeps most of their savings parked in one account, subscribe, and turn on the bell so the next one finds you before it costs you anything.